Hi everyone, I'd like to preface this short video by saying that the bond market is not my area of specialty. So I would like you to listen to this video, and I do think that what I've got to say in it is correct and has some relevance, but please don't take it as gospel. Take it as the beginning of your own research. I really think there's something in it. Anyway, here goes. The US needs to sell treasuries in order to finance its ongoing debt and future commitments. In an ideal world, there would be sufficient savings and demand from within the US itself to do so, a form of voluntary contribution, where citizens invest in the funding of the country's spending by buying bonds. This, of course, is not the case at all, even with the American consumer's newfound love affair with frugality. And so the US must continue to look outside its borders for capital to buy its debt and fund its activities, the bailouts etc. As we know, the Federal Reserve has been buying more bonds, but this cannot counterbalance the obvious drop in buying from China, Japan and newly impoverished Europe. And in fact, the whole idea of the Federal Reserve printing money in order to buy bonds is blatantly ridiculous. It's akin to a shopkeeper buying his own goods and then booking the turnover as part of his business. It's just a loop. It's ridiculous. Anyway, in fact, as I mentioned in my video earlier about buying the oil fund USO, China will, I am sure, continue to quietly reduce their need for investment in US bonds by buying real stuff. Oil, platinum, palladium, base metals such as copper. It makes sense to hoard such commodities at current prices if you have a long-term view, which China does. China is not an emerging power, but a re-emerging power. A few thousand years ago, China was a major power. It's just sat there and been overtaken in the big picture for a while. But anyway, their time frame is much longer than the 4-year political cycle in which the US operates. The same might also be said of India, another immense population of potential consumers outside the US. Anyway, back to treasuries. And the game, one might suggest, is pretty much up. With oil languishing around $50, the Middle East sovereign wealth funds also are pretty much tapped out and have more pressing things to worry about than buying US debt. Dubai, for example, is a financial shambles. Nope. Foreign buyers who can still afford to buy US debt are now concerned about the stability of the dollar and the chances of their bonds being repaid at a value, or indeed in a currency, which maintains their buying power when converted back to the home currency. In other words, it's no good being paid back with devalued dollars if you need that money once you've then transferred it into your home currency, if you've actually lost money on the deal. And yet, foreign investors, including central banks, own $3.16 trillion, which is 50% of the $6.27 trillion in marketable treasuries which are outstanding. Now, this is according to the Treasury's own data. And the US needs to raise $3.25 trillion this fiscal year, as the government finances bank bailouts, stimulates the economy, and services deficits. Those figures are according to Goldman Sachs. So, we have the US heavily relying on foreign buyers, and yet the available capital and taste for US debt is drying up. Not a healthy combination for the bond market. Basically, US bonds might well increasingly need to make themselves more attractive in order to persuade buyers to invest, and that means higher yields through lower bond prices. Just to explain that point, the bonds have a fixed return, and so the interest rate one receives is determined by the amount of cash it takes to buy one. Let's say that a bond will pay you $1,100 at some time in the future. If you pay $1,000 for it, then you have a 10% return built in, $100 bonus for laying out $1,000, which is 10% of the $1,000 you lay out. But if the current price for those bonds is, say, $1,090, then that $10 available profit is less than 1% return on your money. So as bond prices fall, the effective yield goes up. Now, rising bond yields tend to force interest rates in the US higher, as the safe bet of buying government debt should always yield less than the more risky venture of loaning capital to speculative business ventures and consumers. For example, if I can get 10% by buying a secure bond, why would I risk my money in a speculative venture to finance a flower shop in San Francisco for any less than that 10%? I wouldn't. The rate you see on TV is the Fed funds target rate, not the real interest rate. Mortgage rates are always higher than you see the Fed funds rate. That's because the banks are borrowing at the Fed funds target rate, but then they want a profit on top of that, plus some premium for the risk that they carry. So the Fed funds rate is kind of set by the Fed, but they subsequently have to try to manipulate the bond market into accepting close to that in order to encourage banks to lend to ordinary consumers and businesses rather than put their money into bonds for a similar but safe return. In other words, real interest rates in the real economy are tied to the yield available on bonds. The higher the yield available on a bond, the more likely that is to attract money rather than people risking their money by lending to consumers and businesses and so on and so on. Basically, I'm saying that a drastic lack of foreign buyers for US debt could force the Fed's hand and make real interest rates actually creep up behind the increasing yield required on bonds in order to attract willing bond investors. Now, these are the so-called pool of bond vigilantes, who basically look at the situation and, for example, if they think inflation is going to take off, then they're not going to accept a low yield for tying their money up for 30 years. If they expect inflation to rage, they're not going to accept 2, 3, 4%, which is what they've been getting recently. So in conclusion, let me hit you with this thought. And this is controversial, but I'd just like to throw it out. The safe haven element of bonds is still shoring up the price. In other words, people are running scared into bonds because they're not looking for a return on their capital, they're looking for a return of their capital. It's that scary out there still. But if the stock market rallies further, I know it took a dip on Monday, but let's just say that it rallied further, then cash will drift out of bonds and into more speculative adventures such as stocks, in which case bond prices will fall, putting pressure on interest rates to rise because the yield on the bonds is rising, just when the economy is on its sickbed and about to flatline. Higher interest rates is just what everyone doesn't need right now. Ironically then, if my analysis and to some extent conspiracy theory is right, a rising stock market at this juncture is not in the interests of the Fed, as it competes for capital with the bond market and puts pressure on bond prices, the yield, and subsequently interest rates. Now let's see if the Fed can kill the rally with announcements and chase cash back into bonds over coming weeks, because I am absolutely convinced that I've seen this before. As bonds start to fall, we get the bad news coming out. The stock market rallies as money moves from bonds into stocks, and then we get another bad announcement and the thing crashes. Now, of course, the Fed's other problem will be gold, which is the other safe haven. Now, they've been kicking gold in the gut over recent weeks, but I think that interest in gold is growing as any trust in Wall Street, banks, and the entire financial system collapses. So I think we're coming into some very interesting times, but take this as only a beginning and look into bonds. Find out everything you can about how they work and keep an eye on the bond market. There's a ticker symbol for the 20-year plus treasuries, which is TLT. That'll give you some idea of what's going on in the bond market. Thanks. Bye.